Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
Imagine this. You're the chief financial officer, maybe at a global manufacturer. You wake up, check the news, check your terminal, and bam! The Japanese yen is just tanked, say, 10% against the dollar overnight.
Ouch.
Yeah, instantly. All those sales you just made in Japan, all the money you were expecting back, it's worth significantly less in dollars now. Your carefully planned profits, they just took a major hit.
And that sharp erosion of value, that's currency risk in a nutshell.
Yeah.
For any company operating internationally, this potential loss from shifting exchange rates, what we call foreign exchange or FX risk, isn't theoretical.
No.
It's a real daily threat. It can genuinely swing earnings, mess up forecasts, and even, impact your working capital.
Okay, so this sounds like a financial high-wire act. Let's really unpack it. Our mission today is a deep dive into how corporate treasury teams actually manage this constant volatility. We want to go beyond just definitions. We'll look at the hedging toolkit forwards, options, swaps, and maybe more importantly, the strategy behind it. How do finance pros decide when to hedge and when maybe it's better to just accept the risk?
Exactly. We need to cover the mechanics, sure, but also look at some real-world examples, some cautionary tales, definitely like the big losses at Volkswagen you hear about.
Oh, yeah.
And contrast that with the more disciplined approaches. It's really about separating smart financial management from just betting on the market. It's about having rules for playing in the global economy.
Okay, let's start with the basics then. When finance teams talk about FX risk, are they all talking about the same thing, or are there different types we need to understand? What does it actually look like on the books?
That's a great starting point. Finance pros usually break FX risk down into three main types or dimensions. The first one, and probably the most widely understood, is transaction risk.
Transaction.
Yeah, this is tied directly to actual cash flows. So you have a confirmed sale or a purchase order denominated in a foreign currency. The risk is that the exchange rate changes between when you, say, send the invoice and when you actually get paid.
Right, the classic example. You sell something in euros, bill in euros, but before the customer pays, the euro weakens against your home currency, the dollar.
Precisely. That's the tactical sort of day-to-day risk that the cash you receive isn't worth what you expected.
Okay, so that's one. You said three. What are the other two? I'm guessing they're maybe less about immediate cash changing hands?
You got it. The second type is translation risk. This one's different because it's actually a non-cash risk, mostly.
Non-cash, how does that work?
Well, it comes up when a parent company consolidates the financial statements of its subsidiaries operating abroad. Think of a U.S. company with a big operation in the U.K. That UK sub operates in pounds sterling. When the U.S. parent company rolls up those UK results into its overall dollar-based financial statements, the exchange rate used for that translation affects the reported value of the UK assets and liabilities on the consolidated balance sheet.
So even if no cash actually moved between the UK and US, a weaker pound means the UK assets are worth fewer dollars on paper.
Exactly. It creates these paper gains or losses in the equity section of the balance sheet, mostly. It creates, let's say, noise, but doesn't necessarily impact immediate cash flow.
Okay, translation risk is balance sheet noise. The third one you mentioned, economic risk, that sounds bigger, maybe more fundamental.
It absolutely is. The third type is economic risk, sometimes called operating exposure. This is the really long-term structural impact. It's how sustained changes in exchange rates affect a company's fundamental competitiveness and its overall market value.
Can you give an example?
Sure. Let's say you manufacture primarily in Switzerland, paying costs in Swiss francs, but sell globally. If the Swiss franc becomes permanently much stronger over several years,
your products just get a lot more expensive everywhere else.
Right. Your cost base is structurally higher relative to competitors maybe manufacturing in the Eurozone or the U.S. This impacts your market share, your long-term profitability, your strategic decisions. It's much bigger than just hedging this quarter's sales forecast.
That distinction feels crucial. Transaction and translation risks seem like things the Treasury team can manage with financial tools. Economic risk sounds like it needs a CEO-level response.
That's a very good way to put it. If your core manufacturing location becomes structurally uncompetitive due to currency shifts, no amount of forward contracts is going to fix that deep-seated problem.
So what do you do?
Managing economic risk often requires fundamental strategic changes, maybe moving production, changing sourcing locations, shifting your sales focus. It moves way beyond Treasury into overall corporate strategy.
Wow, okay.
So the challenge for finance teams is always this balancing act. You need that short-term predictability in earnings, which hedging can give you, but you have to weigh that against the actual cost of the hedging tools themselves.
That balance. Okay, let's bring it back to the immediate impact. How does this FX volatility hit the income statement day to day? Let's use that classic example. A US tech firm selling software in Europe, invoicing in euros, reporting in dollars.
Okay, so if the euro weakens against the dollar between the time they book the sale and when they report earnings.
Each euro they earn translates into fewer dollars.
Exactly. It directly shrinks their reported revenue in dollars. But it's worse than that. It also compresses their dollar-reported margins because their costs might still be largely in dollars.
And the opposite happens if the euro strengthens.
Right. A stronger euro can artificially inflate their dollar revenues and margins, which might look good short-term, but it's still volatility. Treasury teams, fundamentally, are trying to smooth out these swings. They want to present a clearer picture of the underlying business performance to investors without all that FX noise.
And this isn't just about sales revenue, is it? This volatility must touch other parts of the business too.
Oh, absolutely. Think about it. It affects the cost of raw materials you import, right? The cost of servicing debt you might have taken out in a foreign currency. Big capital expenditure plans, buying machinery overseas, for example, even the valuation of your long-term investments in foreign operations. It's pervasive.
This sounds like where the financial planning analysis team, the FP&A folks, really have to work hand in glove with Treasury.
They absolutely must. FP&A teams run sophisticated scenario models. They have to. During planning season, they'll model, what happens to EBITDA if the dollar strengthens 5%? What if it weakens 10%?
They connect the FX rates directly to the forecasts.
Exactly. To EBITDA, to free cash flow, to debt covenants. They need to be able to tell the C-suite, look, if the current trend continues, here's the potential impact on our ability to fund R&D or pay dividends. Without some kind of hedging strategy, those financial plans are built on pretty shaky ground just based on today's spot rate.
Okay, so if volatility is the big enemy for forecasting instability, what are the main weapons companies use to fight back? Let's get into that corporate hedging toolkit.
Right. Well, there are three main financial instruments, derivatives, that get used most often. The first, and maybe the simplest, is the forward contract.
A forward.
It's basically a binding agreement. You agree today on an exchange rate to buy or sell a specific amount of foreign currency at a specific date in the future.
So you're locking it in, like maybe locking in a mortgage rate before you close on a house. You know the rate you'll get.
That's a good analogy. It gives you complete certainty on the rate for that future transaction. That's really valuable for predictable, recurring things like a steady stream of imports or exports where you know the amounts and timing.
But what's the downside? There's always a trade-off.
The trade-off is total inflexibility. Once you lock in that forward rate, you're committed. If the actual spot market rate moves in your favor before the settlement date, tough luck. You're stuck with the rate you locked in, even if it's worse. You miss out on any potential upside.
Okay, so you sacrifice potential gains for certainty. That inflexibility must be why the second tool exists. Options.
Exactly. An FX option is different. It gives you the right, but crucially not the obligation, to exchange currency at a pre-agreed rate that's called the strike price, on or before a specific date.
Right, but not the obligation. So it's like buying insurance.
Sort of, yeah. Think of it like maybe refundable travel insurance. You pay a fee up front. That's the option premium.
Oh, there's the cost.
There's the cost. You pay that premium for the flexibility. Now, if the market moves against you, you exercise the option in exchange in your protected strike price. But if the market moves in your favor,
you just let the option expire.
Precisely. You let it expire worthless and you just transact at the better spot rate that's available in the market. You still lost the premium you paid, though.
So options give you protection from the downside, but let you keep the upside, minus the premium cost. When would you use those instead of forwards?
Options are really useful for hedging uncertain flows. Things like sales forecasts that might not fully materialize, or maybe when you're bidding on a large international contract, but you don't know for sure if you'll win it or exactly when it would close. The flexibility justifies the premium cost.
Okay, so forwards for certainty, options for flexibility with uncertain things. What's the third one? Swaps. They sound more complex.
They generally are. Currency swaps are typically longer-term agreements. They involve exchanging principal amounts and/or interest payments in two different currencies between two parties over a set period.
So not for hedging day-to-day sales.
Rarely. Swaps are more for big strategic financing needs. For example, managing the currency risk on long-term debt issued in a foreign market or handling complex intercompany loans between major global subsidiaries. They help manage that longer-term translation risk exposure we talked about earlier, or align funding with assets.
Got it. Forwards, options, swaps. But before we get too lost in financial instruments, isn't there a more operational way to manage this? Something called a natural hedge.
Ah, yes, the natural hedge. In many ways, that's the ideal solution because it avoids the cost and complexity of derivatives altogether.
How does it work?
It's basically an operational strategy. You try to match your inflows and outflows in the same foreign currency. So if you have a subsidiary in Germany generating significant revenue in euros,
You try to make sure it also incurs costs in euros.
exactly, you try to source materials locally in euros, take out local euro-denominated debt, pay local salaries and operating expenses in euros. The goal is to have your euro revenues offset by your euro costs within that same entity.
So if the euro weakens, yes, your translated revenue might drop, but your costs drop too when translated back to dollars. They cancel each other out, more or less.
Precisely. It minimizes the net exposure that the Treasury team then needs to worry about hedging with financial tools.
But setting that up sounds like a huge strategic effort, not just a Treasury decision.
Oh, it absolutely is. Implementing a strong natural hedge strategy requires aligning your entire global footprint, where you manufacture, where you source from, how you structure financing. It's definitely a C-suite level initiative that involves supply chain, operations, finance, everything.
Okay, let's pivot to see these strategies in action or inaction. We need some real-world examples. You mentioned Volkswagen earlier as a cautionary tale.
Yes, the VW story from around 2008 is pretty famous in finance circles. They reported losses of over €1 billion related to FX.
€1 billion? What went wrong? Did they just not hedge?
It wasn't quite that simple. The problem wasn't a lack of hedging. It was that their activity seemed to cross the line from risk management into active speculation. They were reportedly using complex derivatives, maybe not perfectly matching the hedges to the underlying exposures, essentially making bets on currency movements.
So they weren't just protecting existing business. They were trying to profit from predicting the market.
That was the accusation and the appearance. When the market went sharply against their positions, the hedges didn't protect. They actually magnified the losses. The critical lesson there, the one finance teams always stress, is you must separate risk protection from speculative trading. They're fundamentally different activities.
Okay, so that's what not to do. What about a company that does it well? Maybe someone like Unilever. They operate everywhere.
Unilever is often cited as a good example of a disciplined approach. They operate in, over 100 countries? Constant currency chaos for them.
So how do they manage?
Their strategy involves a few key things. First, they continuously model profit sensitivity to FX moves, country by country. They understand their exposures deeply. Second, they use what's called layered hedging.
Layered hedging.
Yeah, it means they don't try to hedge everything 100% forever into the future. They typically focus on hedging their high certainty transaction exposures, things they know are coming usually for the next 6 to 12 months out. And they often use simpler instruments like forward contracts for this predictable layer.
So it's more of a continuous rolling process, not big one-off bets.
Exactly. It provides reasonable short-term earning stability without locking them into potentially bad long-term rates or paying excessive option premiums for far-out uncertain forecasts. It's disciplined, integrated, and focused on stability, not speculation.
Makes sense. What about a heavy industrial company like Caterpillar? They sell huge machines globally, operate everywhere. Their approach.
Caterpillar is a great case study because they operate in over 150 countries. They really have to master this. Their approach is very much integrated.
How so?
They combine a strong emphasis on natural hedging wherever possible, really trying to match local currency revenues with local currency costs.
That operational approach we discussed.
Right. But they combine that with targeted use of financial instruments, particularly forward contracts, to lock in rates for large specific equipment sales or purchase commitments. It's about ensuring predictable cash flows for their operations, which is vital given how capital intensive their business is.
It sounds like the underlying principle, whether it's Unilever or Caterpillar, is about consistency and discipline.
Absolutely. You can even draw an analogy to something like Southwest Airlines and their famous fuel hedging. They had a consistent, disciplined policy for years, hedging fuel costs, and it saved them billions when oil prices spiked unexpectedly.
Right.
The specific tool might differ fuel versus currency, but the principle is the same. A consistent, well-understood hedging policy is a powerful tool for mitigating risk and stabilizing the business plan.
Okay, this really brings us to the core strategic question for finance leaders, doesn't it? If these tools exist, why wouldn't a company just hedge, say, 100% of its FX exposure all the time? Just eliminate the risk.
Yeah, that's the tempting thought, but it's generally not the right answer.
Why not?
Well, first, as we've touched on, hedging isn't free. Options have premiums. Even forwards have indirect costs and administrative burden. The potential opportunity cost of locking in a rate that turns out to be unfavorable. Hedging 100% means incurring those costs 100% of the time. That's a guaranteed drag on profits.
Okay, cost is one reason. What else?
Second, hedging everything perfectly is practically impossible. Forecasts are never 100% accurate. Trying to hedge uncertain future events aggressively can lead to overhedging or underhedging, which can sometimes be worse than not hedging at all. And third, some argue investors should bear some market risk. That's what risk capital is for. Trying to smooth out all volatility might not be the best use of company resources.
So if you don't hedge everything, but you also don't want excessive volatility messing up your earnings and stock price, how do you decide when it's worth paying the cost to hedge? What's the framework?
Right. Finance teams typically use a structured evaluation process, often focusing on 3 key factors. Think of it like a funnel.
Okay, factor 1.
First is materiality. Is the potential exposure actually big enough to matter? Would a, say, 10% adverse currency move significantly impact reported earnings per share or key cash flow metrics? If the exposure is tiny relative to the company's overall size, the cost and effort of hedging probably isn't worth it.
Makes sense. Don't sweat the small stuff. Factor 2.
Second is predictability. How certain are the timing and the amount of the foreign currency transaction? If you have a confirmed order with a fixed delivery date and payment terms, high certainty, then a forward contract makes a lot of sense.
Locked it in.
Lock it in. But if you're hedging a sales forecast for 6 months out, which has a lot of uncertainty.
That's where the flexibility of an option might be necessary despite the premium cost.
Exactly. High uncertainty leans towards options, or maybe even deciding not to hedge that particular exposure yet.
Okay, materiality, predictability, and the third factor. Does it go back to the operational side?
It does. The third factor is correlation, which is really about assessing your natural hedges. Do you already have offsetting revenues and costs in that same foreign currency? If a strong natural hedge already exists, the net exposure might be quite small, reducing or even eliminating the need for financial hedging instruments.
So you filter the risks through materiality, predictability, and existing natural offsets.
Right. And based on that rigorous assessment, companies develop and adhere to a formal, often board-approved hedging policy. This policy sets clear rules: what types of exposure should be hedged, which instruments are permitted, what percentage of exposure to cover, for how far out, and importantly, it ensures hedging is used for risk mitigation, not speculation. It becomes part of the overall enterprise risk management framework.
And making this clear to the outside world, to investors, is also important, right? You mentioned that earlier.
Absolutely crucial. The market needs to understand the difference between a company's underlying operational performance and the noise created by currency fluctuations. That's why you see more and more companies, especially in their earnings calls and reports.
Talking about constant currency results.
Exactly. FP&A teams will provide analysis showing revenue growth or profit changes as if exchange rates hadn't changed from the previous period. It strips out the FX impact to give investors a clearer view of the core business health. Transparency is key.
This has been a really thorough exploration. It feels like the big takeaway is that currency risk is just, well, a fact of life for global business. It's unavoidable.
It is, but it's definitely manageable.
Right. It's manageable, but not simple. Hedging offers stability, which is valuable, but finance teams have to be really smart about the trade-offs, the costs, the potential lost opportunities, and that critical line between protecting the business and making risky market bets.
You've nailed it. Mastering FX risk management, developing that sound policy and sticking to it is really a sign of strategic maturity for a finance organization. At the end of the day, hedging isn't about trying to outsmart the market or predict where currencies are going. It's about controlling the financial outcomes of your existing business plan, insulating it from short-term volatility you can't control.
So here's a final thought for you, our listener, to mull over. We've talked about how finance teams increasingly disclose constant currency performance to help investors see the real business underneath the FX noise. Consider this. How well does a company's actual hedging policy, whether it relies on costly options for flexibility or clever natural hedges built into its operations, really communicate its long-term financial resilience and strategic foresight to the market? And could a policy that chases too much certainty, maybe by overhedging, actually end up costing the company too much and making it less agile, less able to jump on unexpected global opportunities? Something to think about.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.